There are plethora of funds available in the market to invest your hard-earned money in, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, on the ET Money Show, we are joined by Hemant Ustiki, Vice Invest Advisors Private Limited. Hemant, good evening and welcome to the show. And let's begin with our first viewer. He's on call. Do I have Mr. Ramesh V on phone line with me?
Yes, thank you, Kavita ji.
Good evening, sir. How are you doing?
I'm good.
Very nice, sir. All right. So you want to invest for 3 to 5 years, right?
Yes.
All right. I believe you're retired.
I just wanted to give a small background of me.
Sure.
I'm 62 now, and I am still. My second daughter is still pursuing the post graduation.
Okay.
So I will have a sale proceedings of about 60 to 70 lakhs in next 3 to 4 months. I'm just retired now, so I wanted to see that my retired life is smooth going. So I wanted you to suggest the gentleman, I just wanted to suggest something like where I can, without joining anywhere as a consultant, or can I lead a good life, marry a good retirement?
All right. So right now the corpus you're talking about is 60 to 70 lakhs. Am I right?
Yes.
The money that you have in hand which you want to invest.
Right.
Okay. And how much would you need every month, sir, from this amount?
About 75,000.
75,000 per month. All right. And there's no other source of income right now?
No other source of income. Only I have a own house, my own flat. I don't have to pay rent for.
All right. So now we have the full picture. Hemant, how can he start? Because 75,000 per month he needs from the amount that he wants to invest, which is around 60 to 70 lakh. And almost for 20 years, we can calculate how much do you think is enough from this investable amount, and where can he put this money in?
Kavita, I couldn't actually hear properly what he mentioned.
Sure.
If I've understood properly, is he still looking at investing for 2-3 years, or now is looking at only investing for creating regular income for the next 15-20 years?
He's looking at investing for regular income, which is 75,000 per month, and that's the only source of income he has.
Okay, Kavita, so clearly, look, he has a corpus of around 60 lakh, and if he needs 75,000 rupees per month, which obviously has to be a post-tax return, so which means that he will require an income of around 9 lakh per annum, okay, which is roughly going to be around 15% on his corpus, if that is the only way he is going to generate income. So clearly, I think it's to be understood very properly that when you're talking about 15%, it's just not possible from any investment option that if you want to get post-tax return, as well as may want to make sure that your money is safe. So I personally feel that either you will have to look at some other source to kind of get some income in terms of whatever you can get from this portfolio. Ideally speaking, you can hope to get around 6 to 7% max post-tax, because what you don't want to be in a situation where your money is not growing. So I think there has to be some amount of rethink on the requirement, because there is clearly a mismatch there. In terms of since the money has to be invested for a longer term, obviously the money also has to grow. So there are, I think, a hybrid fund that would be ideal for him, considering that if he's going to be investing for the first time in mutual funds. Now, there are dynamically managed asset allocation fund, which are called a balanced advantage fund, which typically invests around 30-40% in equity and the rest in arbitrage and debt. And depending on the market condition, depending on the valuation in the market, the exposure to equity goes up and down. And then you can also look at adding one aggressive equity hybrid fund. So I think these are the best options for him if he's looking at generating regular income. And I think the right way to generate regular income would be to opt for systematic withdrawal plan. A systematic withdrawal plan is where you give mutual fund a mandate that this is the amount I would require on certain day. So based on that, the mutual fund will redeem that amount and give it to you. Now, what happens is, despite being invested in a market in product, you're assured of getting that income irrespective of where the markets are going. And of course, the tax incidence also is much lower. So as I mentioned, I think a combination of these two type of funds, and some of the fund I can recommend is like ICICI equity and debt, and then Kotak Balance Advantage and Nippon India Balance Advantage Fund. These are good funds in these two categories. But obviously, considering the fact that there is some exposure to equity, there is bound to be volatility, and he has to be mentally prepared for that.
Mr. Ramesh, anything else you want to ask?
Yeah, just a small thing I wanted to ask. Sir told me that whatever you have to expect 6 to 7% of that amount. So that means whatever expenditure I have, that is it is limited to 6 to 7%. Then only I will be comfortable. That's what you are saying. Or almost you say whatever I have to invest double so that my 75,000 per month will be fulfilled. That's what you are saying, right?
No, let me just clarify that. What I'm trying to say here is that as regular income, you should take out 6 to 7%. Ideally, when your time horizon is like 15, 20 years, with the combination of fund that I mentioned to you, you can expect to generate a return of 10 to 11%. Okay, because two things will happen. One is that you want a regular income, so you don't want to be withdrawing money very aggressively, because when the markets are down, you don't want your capital to go down. So there is always a cushion. Second thing is, your expenses may be 75,000 today, but there is something called inflation, right? Your expenses are going to go up. So for you to be able to keep pace, you need to make sure that apart from regularly generating income, you also must have some capital growth. So ideally, maybe you can expect around 10 to 11% return. But then obviously there is a capital gain tax on that. So post-tax, if you look at 10%, I reckon that you take out 6% or 7% from there and allow the remaining to be coming to you as a growth.
All right, Mr. Ramesh, I hope you've got that point noted. If you have missed anything, I would request you to watch this show on our YouTube channel. Let's move on, and we have Devakar's question. Thank you so much. I have Devakar's question, and he's investing in SBI Small Cap, SBI Magnum Mid Cap. He also has a Quant Small Cap, and he wants to know if he can hold on to these funds or switch to the other funds. And he's been investing for almost 3 years, and he's collected 2.5 lakh corpus so far, and he wants to make 50 lakhs in 10 years.
Well, Kavita, I think two important aspects here. His current investment is around 30,000 per month through SIP, and he said that he has built a corpus of around 2.5 lakh for the last couple of years. Since he has a time horizon of 10 years, he can continue to be invested in equity fund. There is no issue with that. So if I assume annualized return of, let's say, around 12%, and if I look at his current portfolio valuation, as well as his investment through SIP, if he continues this process uninterruptedly, I think he can expect to build a corpus of around 77 lakhs. So I don't think achieving his target over his defined time horizon of 10 years is going to be an issue. But there are a couple of issues, I think, in terms of where his money is being invested. So I feel that there are two, small cap fund and one mid cap fund. So I think the portfolio is quite aggressive. So even if Divakar is aware of what are the attendant risk of investing in small cap and mid cap, I would still recommend that he should, at least stop investing in one small cap fund. So maybe he can look at SBI mid cap, where he is investing 10,000. He can continue with that. Quant small cap, where he's investing 10,000. He can continue with that. And the remaining 10,000, which is being invested in another small cap, SBI small cap, I would recommend that he should include a large cap fund, which is Nippon India Large Cap Fund. So at least it will bring some balance in terms of risk and reward. And I think it will also bring some stability to the portfolio. So my recommendation would be to make one change, make the portfolio a little less aggressive, and continue this process uninterruptedly. As I mentioned, he can achieve his target. But another important point is, since he has 10 years to go, there will be a scope. And if there is a scope, he should try and increase his investment amount. Because sometimes what happens is when you set up a target, you're not very sure of how much you require. So if there is going to be a further requirement, that discipline of increasing your SIP maybe every year can actually be very useful.
All right, we move on to our next query, which is from Mahesh, and he has a lump sum of 6 lakhs to invest in mutual funds, and he wants to do it through SIP, or he wants to understand which is a better route to invest actually, and which funds would you recommend?
I think there are two important aspects that have to be seen. Whether it is to be invested as SIP or a lump sum or a combination of both comes a little later. I think the first important thing is to decide asset allocation as to where this money should be invested, whether it should go into debt, equity, hybrid, and also, of course, which are the fund that can help him to get the best from the asset allocation which is decided. So in the absence of time horizon, maybe I can make a couple of assumptions. Considering that if his time horizon is, let's say, 10 years or thereabout, he can then go for equity fund. And if it is going to be one-time investment, which is very, very important. You see, equity requires two things. One, it requires a discipline of investing on a regular basis, not necessarily always through SIP, because it may not be possible for every investor to invest through SIP. But I think whenever you have surplus, that should be invested. That commitment has to be there. So if it is going to be one-off investment, in that case, I would recommend a mix of lump sum and SIP, which can be done through systematic transfer plan. So maybe in the current situation, I would recommend maybe invest 40% as large cap, as the lump sum, and remaining 60% over the next 3 to 6 months can go as STP. So in STP, what happens is you invest money in the liquid fund of the fund, mutual fund where you want to invest in the equity fund, and give instruction to the fund house to invest, whether on a fortnightly basis or a monthly basis, into the chosen equity fund. So that's what my recommendation would be. In that category, maybe I can recommend 2-3 funds to him. One is, Nippon India Multicap, Kotak Emerging, and ICICI Large and Mid. But if time horizon is not 10 years, let's say if it's around 5 years, maybe then a combination of what I mentioned earlier, maybe hybrid fund, aggressive hybrid fund, and a combination of a balanced advantage fund. Again, I think ICICI Pru equity and debt, and then in the balanced advantage, I mentioned 2 funds, Nippon India Balance and Kotak Balanced Advantage Fund. So a combination of these will work, but like I mentioned, it's important to have a clarity as to what frequency he'll be able to invest after this. And second is what kind of asset allocation actually matches her risk profile. So these are 2 important factors to be looked into before you make a decision as to where money has to be invested.
All right, we move on to our last query, which is from Ankita. She is investing 20,000 in equity and hybrid mutual funds, and she wants you to review her portfolio and to tell her if she can stick to these funds. ICICI Pru Equity and Debt Fund, IDFC Equity Hybrid Fund, SBI Small Cap, Nippon India Small Cap, ICICI Pru Technology Fund.
Well, I think if you look at the total investment of 20,000, which she's making every month, there is a combination of hybrid and equity fund, which is all right, because ultimately, what is also important is your own risk profile. So if that risk profile requires you to invest in a mix of these two, which is fine, because these are aggressive hybrid fund and they have the potential to give a decent return over a longer period. Currently, she's investing 8,000 rupees in the aggressive hybrid funds and 12,000 in equity. So my recommendation would be maybe invest around 5,000 in equity hybrid, because when your time horizon is 15 years, you can actually take a little more risk because you're investing on a regular basis and invest more for, into the equity fund. So that is one, maybe that can be ICICI equity and debt. So that's one fund that she should keep investing 5,000. The problem is with the equity fund. Equity fund basically are very aggressive. There are 2 small cap funds. There is 1 technology fund. Again, my belief is for someone who's investing for a longer period, someone who's not really well versed with, the attendant risk of investing in sector fund, my recommendation always is go into well-diversified fund. So some changes definitely have to be made. Maybe 1 fund she can keep out of the existing fund, which is SBI Small Cap 4,000 rupees. And 2 changes to be made. One is look at Nippon India Multi-Cap Fund, invest 7,000 in that, and then look at Kotak Focus Fund, which is more of a flexi cap fund, but with a concentrated bet, invest 4,000 in that. So I think make these changes. And as I mentioned earlier also, for another query, that the key is continue investing uninterruptedly, irrespective of what the market conditions are. And you will see a very handsome growth in your portfolio if you continue to do that for the next 15 years.
All right, so that's the recommendation for Ankita. And with that, thank you so much, Hemant, for removing time and answering all the questions that were sent to us by our viewers.